Have you ever looked at your chart and felt stuck? Multiple zones to buy from. They all look perfect, but deep down, you're not sure which one will actually hold. Pick the wrong one, you take a loss. Miss the right one, you watch price run without you. Today, I'm going to show you exactly how to fix that with something called the theory of inducement. Think of inducement as bait. It's a zone that looks like the perfect entry, but it's actually a trap. Institutions use it to pull traders in early, then push price to where they really want to fill orders. In a downtrend, you might see two supply zones stacked above. The first, the inducement zone, traps sellers. The second, the true zone, is where the real move begins. Why does the first fail so often? Because of liquidity and imbalances, areas on the chart full of stop losses, breakout orders, and institutional positions. Price is drawn to fill these before making the big move. You might think, why not place limits on both zones? The problem? If the first fails and the second fails too, that's two losses back to back. Try that on 3 or 4 zones in one day, and you could be down 3 to 4% just like that. We're not here to gamble. We're here to filter out weak zones and strike at the high probability one. Let's look at an uptrend. Price is making higher highs and higher lows, so we only want buys. We've got 3 demand zones: high, mid, and extreme. Which one do we pick? Step 1, rule out the top zone. There's a clear imbalance beneath it which will pull price lower. Now we're left with the mid and extreme zones. At first, you might think the extreme is stronger. It's deeper and has imbalance under it. But here's the key. It didn't break the main swing high. The mid-zone did, meaning it's the one that actually built the strength to push the trend higher. That's our true zone. When price reaches that mid-zone, we're now on the 15-minute chart. Instead of jumping into a direct entry, let's walk through a simple entry model that works really well in the Forex market. First, price has touched the M15 demand zone. At this point, we shift down to the 5-minute chart to look closer. On M5, price has tapped into the M15 demand. But remember this, we don't enter yet. In this model, we wait for liquidation. Until liquidation happens, there's no trade. So even though we already found a strong demand zone from the higher time frame, we must stay patient. No liquidation, no entry. Now watch this. Price pulls back and the structure shifts on M5. But notice, no liquidation has happened yet. That means we still wait. Then it happens. Price pulls back again, creates a fake chalk, change of character, above, tricks retail traders into buying, and then hits their stop losses. That's liquidation. Stops are taken out, liquidity is grabbed, and now we have confirmation. From here, buying has a much higher probability. Why? Because we already had a strong demand zone on the higher time frame, and now we've seen liquidation on the lower time frame. So here's the plan. Place a buy limit just above the candle after liquidation. Put your stop loss below the M15 demand zone. Let's play it forward. Price comes down, triggers the buy limit, and shifts structure again on M15. That gives us a double confirmation. Here's how. After the structure shift, we wait for another pullback. On M5, we see a small demand zone within fair value gap. So instead of waiting for a deeper move, we place a second buy limit at the FVG. Stop loss goes below the M5 structure. That's a double confirmation entry. One from the M15 zone plus one from the M5 FVG. Now for targets. Simple. Aim for the M15 high. When we run it forward, price reacts perfectly, moves higher on M5, and eventually hits our M15 target. This is how we should trade. Start with a strong high probability demand zone, then refine on the lower time frame. Enter with a small stop loss, and manage risk properly. Follow this entry model and you'll have much cleaner setups. If you want more, check my previous videos where I explain other entry models in detail. For now, let's move on to the next topic. So, we're looking at the 4-hour chart for USD, and we're going to identify the best zone to buy or sell from. Looking at these highs, the market has pushed down and broken structure. That means our focus is on this leg of price action, from the high down to the current price. The question is, where would be the best point to look for a short? Would it be the zone at the top, this middle zone, or somewhere within the current price action? There are 3 options here. First, there's no clear zone at the bottom, no open imbalance or supply zone. Just to clarify, an imbalance is simply an open price range after a strong move, like this area here, that hasn't been retested yet. Since there's nothing like that at the bottom, we can eliminate it. That leaves us with the 2 zones above. Generally, the zone that caused the break of structure gets our attention first. That would be this zone here. I mark my supply zones using the last candle before the impulse, so if price returns to this level, it could be a potential selling area. However, there's a catch. This zone shows clear selling interest, but we also have a cluster of relative equal highs, 3 points that hit almost the same level. This acts as resistance and creates liquidity above, and we know the market tends to move toward liquidity. So, with these equal highs in mind, we look further out to the extreme zone, the furthest zone from current price in this leg of the structure. This is the swing high of the leg, where buyers previously failed and the trend reversed into bearish action. In this case, the first zone is actually inducement, a high-risk area to sell from because price might push above it to grab liquidity. The smarter play is to wait for the market to pull back, take out the high, move into the extreme supply zone, and then sell off. Running the market forward, you'll see it trades through the inducement high, touches the extreme supply, and then drops into new lows. A potential trade would be selling from this extreme supply zone, with targets set at the swing low. This simple rule helps you avoid selling too early and getting caught in inducement. Always watch for equal highs. Don't sell beneath them. The highest probability zone is the extreme of the move, away from equal highs, and that's the area we focus on. We're looking at GBPAUD on the 4-hour chart. This method works on any time frame, but we'll stick to the 4-hour for this example. From the current price, we have 3 possible demand zones. Zone 1 at the top, Zone 2 just below it with some imbalance, and Zone 3 lower down, which is marked by an indecision candle. When I mark a demand zone, I simply take the last candle before a strong move away. Nothing complicated, just the last candle before the impulse. Now, if you wanted to buy this market right now, which zone would you choose? Let's check them one by one. Zone 1 doesn't look strong because it hasn't caused a break above the recent high. No break of structure means no clear sign of strong buyers here, so we can remove it from our list. Zone 2 is more interesting. It actually did cause a break of structure, and there are no equal lows below, which is good. But here's the catch. When a zone breaks structure and is still unfilled, zones above it are often inducements, meaning they are traps to take liquidity before price moves to the real level. This zone also has an imbalance below it, so price might come down, fill that imbalance, take out the buyers here, and then head to the real zone. Zone 3 is that real zone. It showed strong buyer interest, still has imbalance left, and hasn't been retested yet. It's also the last point in this trending leg where price can reload before moving higher. The trading plan here is simple. Wait for price to tap into Zone 3. Set your stop loss below the low, and aim for the previous highs. If we play the chart forward, you'll see price takes out Zone 1, takes out Zone 2, then finally reacts from Zone 3 and pushes up to a new high. In short, Zone 1 had no buyer control. Zone 2 had inducement liquidity, and Zone 3 was the true demand zone with imbalance intact. And that's why it worked perfectly. Just watching the market isn't enough. You also need to practice with backtesting. That's the only way to know which zones work and which ones fail. Also, don't forget to check out the other entry models on my channel. I hope you found this helpful. Practice these concepts before trading with real money. See you in the next video. Don't forget to like, subscribe, and comment below.